Hi, watching Investor Insights, and in this video I just want to talk about the European debt crisis. Basically, it comes down to interest rates rising. By interest rates, I mean the rates that the European countries had to repay their debts. Now that is not set by the government. As much as the government tries to influence it, like the Fed is, in due time the market decides. And once the market decides, they were gone. Take a look at Greece. Now, their 10-year debt went to, I think it was like 39%, something along those lines. Please don't quote me. And this came about because people who were holding Greek debt just took a pause and just thought, I don't think that they can pay us back. So they sold the bonds. Now, when a government needs money, it issues bonds, and the bonds have a face value and a dividend and a yield. Now, when the value of the bond goes down, then the yield obviously goes up, or the interest rate goes up. So as the value of these bonds collapsed, the money that the government had to pay was a lot higher on face value. So in Greece, that happened to be 39%. And for a country that's contracting, the government can't afford to repay debt at an interest rate of 39%. That's crazy. So, through some negotiations and a whole bunch of BS that happened, investors had to take a haircut. And the bonds almost went to nothing. And you always hear about the odd speculator lemming that jumped in and bought a whole bunch of Greek debt at very cheap price, i.e. at like a 39% yield, and it's gone back down now. I think it's about 15% or something like that. It's still ridiculous. But there won't be any recovery in Greece. They can talk about it all day long, but with a public sector that occupies half of the economy and half of all the employment in the country is in the public sector, and austerity measures that are totally out of whack, you can't have a growing economy. And then you've got the cost of all this debt going up. The public sector just can't afford to survive. They can't afford to live, sorry. So what's happening in Europe, or what happened in Europe, I should say, was a crisis in confidence for those countries to be able to repay their debt. And that crisis or loss in confidence has led to their bond markets being trashed and the market setting much, much higher rates for those countries' debt. Now, magically, in July last year, in 2012, Super Mario came out and made the famous statement that he'll do everything it takes to save the euro, or to protect the euro and whatever it stands for. And through those words and subsequent a whole lot more hot air that came out of him, the bond market recovered, and interest rates are lower now than they were then. So the governments are now much more happier because they can afford the debt. And the whole world is happier, and stock markets are at multi-year highs again. And who knows what's going to happen in the future. Despite all the happy talk and all the froth in the market, what started the crisis is still there. The crisis wasn't the loss in confidence in the bonds. The crisis wasn't rising rates for the governments on their debt. The crisis was, you guessed it, the debt. the debt is still there. And you want to hear an even bigger joke? There's more debt. Because those countries are using this environment of lower yields to take on more debt. They have more debt than ever. So if you think the first credit crunch was an issue, you wait when inflation causes rates to rise. And this time, there's nothing Super Mario can say or do that can save Europe from imploding and evaporating into nothingness. Because they didn't fix the problem. That was the European debt crisis. They, through just a whole lot of hot air through Mario Draghi, calmed it down, and in fact, they've blown it up even bigger now. There's an eerie similarity to what happened in Europe to what is going to happen or what is happening in the States right now. The market dictates the rates. It doesn't matter if the Fed tries to buy more bonds or do whatever it does to artificially price fix or artificially fix rates through the purchasing of bonds. Inflation's gonna win eventually. Because as you know, you've got so much money, such an infinite supply of money chasing a very finite amount of goods and services. Inflation is just going to run rife. And those bonds are going to get trashed. The thing about America is that the debt on its books is more than all of Europe put together. And if you saw what happened in Europe, you wait until you see what's going to happen to the US. And I hope that you're not a bond market speculator anywhere. If you are, get the hell out. Because this is one slow motion train wreck that once in motion, there's going to be nothing to stop it.